Hey, welcome back, everybody. It has been a wild week this week. Markets all over the place, up, down, sideways, everything. Let's rehash it. Let's start from this weekend. What happened this weekend that triggered Monday, which was a major selling day, 1,000 points in the Dow? What happened?
Yeah, we wrote about this. Hopefully you all are getting our content. I think we put something out early Monday morning, so that was fantastic to get something out to people to let them know what was happening and so forth. There was a variety of things, though, that happened, Logan. It all started with the previous week, of course, where we had negative economic news that were sort of starting to tip the scales to the point of the general investment world believing, as we have for some time now, that the Fed is late, that they're behind the game, and that the economic imbalance is such that we're moving much faster into a recessionary environment than most people believed. And that was because of non-farm payrolls, the jobs data. It's sort of the last domino to fall. And it's ironically what the Fed's been waiting for, but what our contention has been is that by the time an employer lets someone go, that means business has changed so dramatically that they have to cut expenses.
Yeah, that's normally the last thing they do. They're trying to cut every other way before they try to let someone go. Once that's coming through a jobs data report, you know it's probably pretty bad.
That's right. And so we've been in this environment for a while where bad economic news has ironically been good for stocks. And the reason that has been because the softer the economic news, the more probability or the higher probability that the Fed would cut rates. However, and I've given this analogy before, when the temperature is coming down, you get excited as you become, if you're a parent, you see your temperature in your child coming down more towards normal, that's great. But you don't all of a sudden want to go below 98.6 because now we have a new problem. And that's what market participants were sort of, grappling with to end last week. There were a couple events over the weekend, however, that really put the nail in the coffin, proverbial, if you will, that said, hey, the sell-off is going to accelerate. One, very easy to explain, and that is that Berkshire Hathaway, Warren Buffett, sort of the legendary value investor, had to disclose the holdings as they do every quarter, and they do it. They're unique. They do that over the weekend, probably to not move markets. And it was pretty dramatic. His exposure to technology, specifically Apple, had dropped considerably.
He basically cut it in half.
And he's a value guy, and it's exactly what we've talked about on television. I mean, I think the very week before I was on a show, I know we've put that out, and I said I'd fade Apple here. Now, we have many clients that have owned Apple for many years, and, I'm not saying that Apple is done being the greatest, one of the best investments of all time, but, the valuation was just so rich. But there was another thing that happened, and we've not delved too far into this because it really is a rabbit hole, but you have to understand that there's a lot of things in play in global markets, one of which is the fact that Japan has not raised rates like the rest of the world. In fact, the Japanese Fed funds, if you will, the Bank of Japan overnight lending rate has stayed at zero for the last several years. That's been actually at zero for almost, a decade now, I think. I'm guessing, but it's been a very, very long time. That's allowed people to borrow money in Japanese currency at a very low interest rate and turn around and buy riskier assets, specifically in the United States. And so that has created what's called it's called the Japanese carry trade. And it's predominant. It's happened for years. And so that was thrown in balance. It was thrown out of whack when Japan decided to raise rates. And so a lot of that carry trade was unwound. Now, there's an interesting kind of argument that, and I've seen now J.P. Morgan, Goldman Sachs come out and say, oh, it's 75% unwound and it's perfectly, fine. And then I've heard other people say, well, no, that's still dramatically in place because they only increased it by a small amount. Right. And, there are other areas around the world where you can even risk-free get a significant return on your investment. So you had a shock to the system. And whenever you have a shock to the system, you get a very rapid sell-off, especially when asset prices are extremely high as they have been. And that's what we saw. The reason that I don't feel that it's, this dramatic, start to a new bear market are a variety of reasons, a couple of which I'll share with you here. The first is it was a shock to the system. And whenever you have a shock like that, a bank or a Federal Reserve, in this case Bank of Japan, can come out and reverse or protect their position very quickly. And it's exactly what they did later in the week. It's why yesterday, was one of the best days in our markets because the Bank of Japan did take action. That's number one. Number two, let's not forget we're in an election year.
Yeah.
We're in an election year, and our Federal Reserve has a Fed funds rate at 5%. Mm-hmm. The firepower that the United States Federal Reserve has right now to propel this market has been greater than it has been in many, many years.
And just to go on that point, that morning, Monday morning, it was looking really rough pre-market. And then a Federal Reserve board member came out and said, look, if this gets bad, we'll fix it. They came out and said that news, and throughout the entire day Monday, it was still a rough day, but throughout the entire day, the market kind of got bought up. So that firepower that they have kind of protected the markets on Monday.
I don't think volatility is done. Everybody's asking me, what are your thoughts here? And I say, look, the year still has been a solid year. Markets got well ahead of themselves. When they get well ahead of themselves, there's often a shakeup. We never know why. We have somewhat anticipated this. I mean, listen, a webinar talking about our movement out of technology, reduction of technology, and into United States Treasuries. That's had one of their best runs in the last several months. But this is not surprising. I never make light of losses. Nobody likes to see money, paper losses occur. And nobody likes that. But the reality is volatility, I think, is here to stay, especially as we go into this election. There are uncertainties that have been introduced. But when we get these extreme emotional responses, it's often more of an opportunity than not. Now, that means you have money on the sidelines and, you could take advantage of that and so forth. And I know some people did that, and we did that in certain instances of new clients and so forth. But I think it's important we all take a deep breath. We know that it's been a great year. 2023 was a fantastic year. We're going to have volatility into the election, but it is an election year, which means the incumbents certainly want the economy to be looking strong and markets to not be, declining considerably. And the Federal Reserve has incredible firepower.
Right.
So I do not think that the bull market is over. I think everybody needs to sort of take a breath, collect themselves, and know that we're long-term investors. Volatility is part of the game. Sometimes it's more apparent than others. But the other thing I'll say is this. The response. Now, this is going to get a little weeded, and I'll be carefully to choose my words here. The psychological response that we saw in the very first part of the week tells me
it's not a top. Right?
It's not a top. And the reason is that when the markets topped, and I mean really topped at the 2000 bubble burst, the psychology was such that people wanted in.
Yeah, I got to buy that dip. Get me
the dip. Oh, this pullback in JDS Uniphase or AOL or whatever. Should I buy? And they did. They bought. Often they borrowed to buy, not only against portfolios, but sometimes houses and credit. I mean, unbelievable. But the psychology was, I don't want let this opportunity pass me by. That is not the psychology right now.
No.
To have a change in that psychology to where we go from, oh my gosh, should I sell, should I get out, to should I buy, these sell-offs will need to be recovered very quickly. I'm not saying that's going to happen, but it's interesting. And it's going to be something I'm watching very closely, because imagine, if you will, if in a couple weeks we're at new highs. Yep. And people look back and they know themselves and they go, wow, I got really nervous. That was dumb. I shouldn't have got nervous. I should have bought. And they say to themselves, the next time this happens, I'm going to buy. And it might happen again. And then they might go, oh, no, but this one is scary. No way. And what happens if it goes again? See, this happened in the 90s. People forget this. In the late 90s, we had massive pullbacks, recovered very quickly.
Right.
And people
went higher.
oh,
Not
yeah,
just went
off to
much
the
higher
races.
than- yeah.
And then people were like, well, that's crazy. I missed out on that opportunity. And they got empowered. They got emboldened. And when that psychology changed is when it no longer went to new highs.
Yeah.
So those are just things we're observing, anecdotal. We're just observing them. But, shock. I don't think the volatility's done. I think the volatility's here to stay. It's going to keep us on our toes. But if we keep pressing to new highs, I will say this. This is how I'll conclude. I know it's been longer than we wanted, but no writing this week. We'll just do the video. But if we keep, let's say this recovers and we go to new highs, and we go and we keep getting, we will keep taking steps back.
Right.
Bigger picture. Because our view, and it continues to be, we've been, I think, pretty confident or pretty clear in this, we do believe this year will be strong. We even believe the 25 can start strong. But we do believe that the debt situation, both government, personal, municipal, is a problem.
Yep.
And that's down the road, but it's something we're going to be very, very aware of and take steps, hopefully, in the future to protect even further.
Yeah, and I think we'll add some of the clips that I talked with Jack earlier this week to the bottom of this video. But I think it's important, too. We've talked about inflation for a very, very long time, and it's still there. But I think the conversation is going to shift very much from inflation, and now the word we'll be using is recession a lot.
Yes.
So as we're watching this economic data, there's CPI, PPI next week. We'll be talking about that. We'll be writing about that. But that's where it's going to shift to is, are we going into a recession? Can the Fed still save us from a recession? Those kind of conversations is what we will be having, and we'll shift our focus more to that. And then obviously behind the scenes, you and I will be watching and thinking, okay, is this time we should be peeling things off? We should be backing off. And
That's
backing
right.
down.
We're not asleep at the wheel.
Yeah.
That's for sure. We're working hard every single day, communicating, and hopefully you find value in that. If you ever have any questions, don't hesitate to reach out. We thank you so much for your trust in us, and we wish you the best and have a wonderful weekend.